Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap of the trades that we made Friday and then the one trade that we made on Thursday. Didn't do a video on Thursday night. Again, just one trade in Amazon, so we'll go over that one today. Didn't feel like we need to do a whole video on that, but we will go over in detail some of the trades that we made closing wise and some of the adjustments that we might have coming up for some spreads now that we have earnings that are coming out for a lot of the securities that we're trading. So we've got things moving all over the place, and so I want to go over those in detail. I know I've had a lot of questions about this. Now, as always, on these video trading recaps, they're just for members of OptionAlpha.com. If you're not a member and you're viewing this video on YouTube, you're probably getting this information 5 to 7 days after we send it out to our members. So you can't take advantage of these trades after they've been sent out to members. You got to sign up for your trial at OptionAlpha.com. So let's just quickly go over the one opening trade that we had earlier in the week, and this was on Thursday, and I just tag it as 1:30 as the date that we actually opened this trade. But we sold a vertical put spread in Amazon right before earnings of 365, 355. The 365, we sold those contracts, bought the 355s, took in a credit of 110 on the overall spread. Now again, this is a very small position around earnings, but we thought Amazon was going to go higher after earnings. It seems to be the case usually. It goes a little bit higher after earnings, or it has been the trend. And of course, it didn't do that this time. It actually had great earnings, but missed expectations. Expectations were very lofty for Amazon going forward. Now you can visually see on the chart that one thing that we did want to happen actually happened, and that's a crush in volatility. So volatility dropped from near the 100th percentile down, and it's now at the 35th percentile, which is designated up here in the top left hand corner. So that's working really good for our position. Our first strike is at 360. So our first strike is right here. So the spread is actually just a little bit in the money right now. And that's okay, and we still have plenty of time between now and expiration. But what we're going to try to do is just wait for a little bit. Volatility should continue to fall. You can see that historically this is still very high for where Amazon usually trades. Usually trades down here around the 10th or 20th percentile. So we've got some more drop in volatility, which will decay the premium. And then as we get closer to expiration, that will help also. So if we don't see any sort of bounce in Amazon, since we only have a put side position on, what we'll do is come back in here and sell a call spread against the position, which doesn't add to our risk, but we'll sell a call spread probably around 370 or so, depending on where Amazon is at. Again, selling this call spread with the same width and the same number of contracts as the original put spread that we have on now does not add to our risk. It only increases the credit that we get, and it'll basically become an iron condor. So that's one way that we can adjust this position, but since it's not really too far deep in the money and we're not very close to expiration, we've got a lot of time. We feel that some sort of market cyclicality can come back into the market, have a nice little rally in Amazon, or at least a dead cat bounce is what it's technically called on charting, a little bit of a dead cat bounce, and give us an opportunity to take the position off at a profit. So that's our trade on Amazon. Now let's go to closing trades. So one of the closing trades that we had on Friday was a partial close of the VIX call spread that we had on. And I want to go over this one in detail because I usually don't do this type of partial close and leave one option open. But with the VIX, it's a little bit different because it tends to come back down after it's had these pop up in volatility. Volatility usually comes back down at some point during the month. So we actually had originally the 17-19 vertical call spread in the VIX. And I only closed out the long side of the trade. So I sold back the 19 calls for 130 in credit. So I made a nice profit of $47 per option that I sold back. So I sold back 5. So I made a very good profit on this side of the market, right? But we also had the short position that was working against us as the VIX continued higher. So what I did was leave that position open, and I want to go over this in detail so that you guys understand why I left it open and where our new break-even points are. So again, you can see this is the VIX. It's had a huge pop-up in volatility over the last week and a half, which is fine, and as it's moved up, we've made money on the call position that we had bought. Again, we sold the 17 strike calls, bought the 19 strike calls. So now that the 19 strike calls are gone, we're basically left with the 17 strike calls naked and short. So a lot of upside exposure in case volatility does go crazy, but we're keeping this position small. But we are left with the 17 strike calls that are naked. Now let's go to the Analyze tab here on Thinkorswim, and I've already brought it up. So this is actually the VIX. And if you don't understand these charts, I have a ton of video tutorials on how to use these right here inside our membership area at optionalpha.com. Just click on the video tutorials section and you'll go right over there and take a look at those. But right now, this was our current position in the VIX before we actually bought back that call spread. So I added just a simulated trade just to show you guys exactly what it was. We bought these at 83, sold the 17s at 113. This was our vertical call spread. This is what that profit and loss line looked like before we exited the 19 calls. So it looks pretty good. We're actually in the money here with this call spread as it was before we actually made that trade. So what we did is we went in there and got rid of the 19 calls. And by doing that, it changes our profit and loss to look like this. So now this is what our profit loss statement looks like. We are totally short these 17 calls. So that's where you see the option diagram here pivots at 17 and just goes down from there as far as losses go if the VIX continue to rise. But what I want to point out is how to calculate the new break-even point. So we originally sold the VIX 17 calls for 113. Now that we're naked those 113s, we add our strike price, which is 17. We add 113 to the strike price. That moves our break-even point out to 1813, which is just a couple cents shorter than where the VIX closed at 1841. So now our break-even point at expiration is moved up and not so far low as it was before. Before it was down 1730 or so. Now our break-even point is moved up to 1813. So that gives us a little bit more room to be right on this trade if the VIX continues to move down. Now ideally, we're not going to hold this position very long. As soon as the VIX drops down, we make a nice little profit. We're going to double side this trade, get out of it. We're not going to look to hold the VIX trade like this naked all the way through expiration. This is definitely a type of trade that you want to manage. Again, not your typical trade, but we are taking advantage of both sides of the market. If the market rallies up here with volatility, we took some profit off the table on one side of the trade, and now we're going to hopefully take some profit on the other side as the market continues to move lower. All right, so getting back to some of the other closing trades we had, the vertical spread in Facebook was pretty self-explanatory. Facebook had a huge pop after earnings. We had originally sold the 52.5 50 puts, bought those back for a 9-cent debit, made $58 per spread that we sold on that, practically all the money we could possibly make on that. No sense in holding this all the way to expiration as we continue to preach and preach and preach. With these vertical spreads, you get a nice little profit like this. You get 50 to 75% of your max profit. Take the position off, lock in those trades. Last one we're going to go over tonight is Google. So Google had really good earnings as well, had a nice pop in its shares after the earnings were released. So what we did is we actually had an iron condor on Google, and I'm going to go over this one in detail like the VIX. We bought back the put side trade that we had for 45-cent debit and made $90 on each spread. And the reason that we did that is because Google jumped in price, so the puts are going to decay, and volatility contracted. And so we bought these back with the understanding that at some point between now and expiration, we will likely roll up to a higher strike put selection and take in some more credit. And so that's what we're going to try to do, just like we usually do with a lot of the iron condors and adjustments we make. At this point, we just have the call spread, and you guys will visually see this here in a second. We just have the call spread side of the trade, which is deep in the money, and that's okay because we're still on the dance floor here with Google. Google can move very quickly, very fast. What we want to do is take an additional credit. We've basically made all we can make on this put spread, sans the 45 cents on each side. We want to roll this up to something that's a little bit more lofty in price, so something around $1.10. Take in some more credit and add to our overall credit that we've made on the position, which just helps reduce the max loss. At this point, it was a very small position. Who knows what earnings could have done? And right now, what we want to do is try to reduce our loss on this trade rather than just leave it here and take max loss on everything. We want to actively manage this position now that it's in the money to reduce our losses all the way through expiration, if at all possible. So that's what we're going to try to do. And I want to go to Google. I've set up a couple simulated trades here for you guys to see exactly where we're at. So again, right now this is our position. I have a simulated trade down below, but right now our position in Google is we have just the 1140, 1145 call spread. So this is what our position looks like. Very simple vertical call spread that we have. But here's the problem. Google's trading at 1180. Again, we're still in the dance floor here, so we're still within a statistical probability range that it could rally or fall back down before expiration. So we don't want to get rid of this position because it's basically lost all the money it can lose. It's a position that we have on. We're still in the dance floor. Statistically, there's still a probability that we can make some money on this trade. What we do want to do, though, is actively manage the position that we had down below the market. So we did have the 1040, 1045, or 1140, 1080, 1085, those strikes below the market. We want to move those strikes up and sell something a little bit closer to the market and even go inverted, which is a little bit different concept for some of you, but even go inverted here and take a look at selling the 1160, 1155. Again, we did not do this. I'm showing you guys how we look at simulated trades and how I look at these and kind of playing around with the figures. But in this case, we want to go inverted on here and take in a nice big credit. All we're concerned about doing at this point is taking in more and more credit. That's what we want to do here. That reduces our overall risk exposure on the trade. So what would have been a max loss if we just leave this position on of 686 on this side of the trade, 686 on this side of the trade, if we go inverted here and sell this 1160, 1155 put spread, that takes our max loss down to 376. And so that's what we want to do. We want to take our max loss down, reduce our risk exposure, and hopefully take in a little bit of credit on the way. And so we'll keep actively managing this trade. Again, this is not a trade that we've made. We're looking actively at this. I want to see what Google does next week after we have some nice long weekend here and people start taking money off the table. I want to see where Google trades after that. You'll notice on the charts that we still have a nice long drop here to continue in volatility. So volatility, even though it did crush after earnings, which it usually does, we still have a long time here for Google to continue to move lower with its volatility, which will only help our call spread position, help decay those options, bring those premiums in tighter. So that's what we're going to try to do. Again, Google's very fast mover, so we could see this definitely turn around. We've got a lot of time between now and February expiration, so anything can happen, and we're still in the dance floor. So take the money off the trade for the bottom side of the market, and let's see what we can do on the top side. So again, hopefully you guys, this is really helpful for understanding why we're making some of these adjustments, especially with positions that are already in the money or close to in the money. The key with everything that we do here is that you can't trade too large of a position to make these types of trades hurt you. So if you were trading 10, 15, 20% of your portfolio on one trade like this obviously is going to kill a lot of your profits. But as you've seen over the last week, we've been taking profits off the market each and every day these last 2 weeks. We've been taking trades off that are profitable, and that helps us buffer trades like this that go against us because we keep our trade size small, because we do take profits on the profitable trades, that we have the luxury of letting these trades work now all the way through expiration if need be to then show a profit. So again, hopefully this is really helpful. As always, please add your comments or questions below this video. I'll get back to everyone this weekend. Hey, have a great weekend. Enjoy the Super Bowl and go Broncos.